create new products and facilitate a higher uh, element of what I consider digital transformation in a very elaborate process of managing finances in general across uh, uh, variety of asset classes. So our root background goes to what I consider securitization and assets that were either consumer credits, commercial credits, or commercial real estate related or asset based or highly structured products which had transparencies attached to it and therefore required a whole lot of information that needed to come together to be able to represent those assets in the marketplace from a where they are and where they're going to be. So today I will be helping and facilitating this group because we have some fairly uh, good experts online here and helping us to really understand the events, the current events that were predicted but not really acted on early enough in the pandemics and the pandemic impact on the very unprepared global world that is facing those issues. Hopefully, the panel will help us to understand what are the key issues, and hopefully we only focus on fintech side, meaning that how can fintech come in and help us in reducing the pain if possible, but also prepare us going forward to reduce the economic impact if possible. With that, maybe I will hand it back to Jason to provide us his view of general perspective of how he sees it from a short-term and long-term impact to where we were in January, let's say, or early February. Obviously the economy, if you can keep it short on that, because there are a lot of information on that, and our panel would probably not be able to address all of those. But having your own personal view on a short, brief way would help. And then how you think it will change the direction of where fintech was going. And I don't want to limit fintech to just crypto-based currencies and assets and projects, because that's just one element. But I think the fintech in general is a much wider area, and it's definitely being adopted more widely. Please, Jason.
Sure. So what I would say is this: I have somewhat of a unique unique opportunity to see what's happening in markets before they're happening because of my distressed real estate practice. And what I was seeing was that you were getting the stuff that was on the edges in the economy from, I would say, the summer of this past summer, the summer of 2019. They were starting to show cracks. There were large loans that that weren't properly collateralized or had some sort of issue, and they were having problems. It started to really get busy, I would say, in October, November, December, and you were seeing, and by January and February, there was a lot of my lenders that had different portfolios and different types of collateral were coming to me with issues that they had that related to problems with the underlying loan. So that was already starting to break. Obviously, once the shutdown started to happen, it changed pretty much everything, and everything came to a screeching halt. And we're only going to see that get worse. I think I mean, I'm not an expert. I don't, as far as the economy goes, but I don't see this from a legal perspective changing for at least a year, because there's going to be a lot of underlying stability that's going to have to reassert itself in order for things to get back to the normal part of what the distressed cycle was likely to be. But the other part of that is what I've also seen is the immediate changes where everything had to go online. that's been caused by the various shutdowns of the entire world, I think it's only going to increase the importance in society as a whole for a lot of the fintech solutions that many people didn't really think applied to them, but does apply to them now. So that's overall, I think that this will help the fintech community and the people that are in the fintech world, because people are going to be more interested. Now they have to. Every law firm is virtual. There's not a single law firm that I'm aware of that's a large law firm that's virtual. We have 900 attorneys in 26 offices at Pulcinelli. It went virtual overnight, including our secretaries. So if that happens to law firms, and particularly big law firms, that's the hardest. That's emblematic of society. It's kind of, they're a lot more conservative and staid. And so I think that it's going to increase interest unilaterally for the fintech products in space.
Very good. Thank you so much. Maybe we go to Dan, and maybe perhaps from your end, because you're on the solution providing side of the equation. Are you seeing a lot more demand, a lot more, are you essentially validating some of these issues? Are you seeing reactions? People are quick enough to want to change their ways, or any comments along that direction?
Yeah, so I think I'll be speaking from the fintech startup perspective. So one of the main things that's going to happen in the short term is that a lot of blockchain startups are going to fail. It is a very difficult time to raise capital, and a lot of the VCs that are funding the sector are going to be focused on their existing portfolio companies. So if you're a startup that doesn't already have existing VC relationships, you may be in for a rough ride. So I think there's definitely going to be a consolidation going forward. Over the next few months, either consolidation or players just dropping out. That's the main thing that's going to happen. In terms of areas where we've seen increased interest for blockchain applications, supply chain transparency and healthcare records. Healthcare records to be able to prove who is immune, of course, and supply chain transparency, given all the disruptions that there's been across different supply chains, to understand who you are dependent on and where are any potential roadblocks. We recently announced a couple of weeks ago a project with a company called GrainChain that tracks grain commodities on a blockchain and enables farmers to sell directly to buyers and get paid instantly. They've gotten a lot of media attention because people want to understand, given that their transparency into the very early stage of the supply chain, directly at the farmer level, what changes have they observed in volumes in their platform? And actually, they've seen a drop in volumes because a lot of farmers are not even willing to enter these contracts, because even if they have the production, they are not sure if there will be the necessary people to harvest the grain when it's ready, and the logistics, the truckers, the distribution centers, all these things, if they're going to be there to actually be able to deliver that grain to the buyers. So there's definitely a higher interest in supply chain transparency. And then last, and this is somewhat tangential to blockchain technology, of course, is what Tim Peterson was making reference earlier, that this time around, something that has affected the crypto market in general is the high correlation with traditional markets. So crypto used to be an area where you could go and get uncorrelated returns with the general markets. And as you had more institutional investors coming in, they start behaving as institutional investors do, which is in a risk-off scenario, institutions flee the market. So if you had a lot of institutions invested in Bitcoin and other altcoins, the moment things get hairy, capital gets pulled out. And that's why this time around, cryptocurrencies in general were so highly correlated with traditional markets. And it actually comes at a time where the crypto market in general was expecting a huge upside, given the halving of Bitcoin that is coming up, I think, over the next few weeks, which in the past, there's been a spike in prices once there's a big halving of the Bitcoin protocol.
No, that's very interesting. You brought in the supply chain management and be able to, for people try to predict, the whole cycle and be able to manage their resources better. in some ways, having that information makes people a lot more agile, and it may, to some extent, add to the volatility because they may not they may essentially predict certain things, or certain uncertainties become a lot more apparent, and as a result, they're going to pull back and manage their finances a little bit better themselves, but ultimately create issues at the overall uh, delivery cycle. Um, uh, Jason brought up a very interesting point, probably after travel and cruise and restaurant business, real estate, specifically retail, real estate is probably going to experience the largest disruption, if you will. And as we all know, one of the biggest technology-driven platform was things like WeWork. WeWork obviously had planned to transform real estate in some ways. An office, perhaps, again, here's a situation that the same efficiency that works very well in efficient markets, when you get volatility, it may work the other way. Maybe Jason, you can elaborate a little bit on that in terms of the different classes of real estate and the interaction of how potentially managing that the stock of real estate available, perhaps, and the role of technology in that going forward, and how could technology help to somewhat reduce the pain?
Well, as far as real estate goes, I'm not so sure that technology is going to reduce the pain. I suspect that technology is going to make the pain in real estate a lot worse. But the reason is fairly simple. It's because technology allows everybody in New York City to work from their houses, everybody in the metro area to work from their houses. And so it's going to, now everyone has been forced by this plague to stop and work from their home. Unless you're in a direct service industry like the restaurant, the hotel industry, if you own a gym, everybody that can is working from home, and those businesses are not open unless it's a restaurant for takeout. Hotels, I think 3 weeks or a month ago, Marriott's report was showing that they were down to 25% across the world. I think that in New York, the hotels have 5 or 10% occupancy where they're normally at between 80 to 95%. So I think that in the real estate sector, what you may see is a reshuffling and a reduction of prices because there's going to be a lot of inventory. And if you own a building right now, an office building, I think that you're somewhat worried, because any company that is a business, accounting firms, law firms, even manufacturing firms, the business side of it, they don't need to physically be in one spot. They could all work anywhere. You can have a conference via Zoom meeting. So I think that that's going to shift the priorities, and perhaps we'll have you're going to see local governments, I suspect, trying to make it easier from a rezoning perspective to allow some of these offices to be repurposed. And I think we're going to really see a change in the economy because technology is going to fix what it is that the way it is that people work. So I thought that we would be moving to the WeWork model on a company basis in 10 years. I was on a panel about a year ago, and I figured it would be about 10 years. I think now that's going to change, and we'll be moving to the WeWork model, the office hotel model right now. I think that if you're in the middle of signing a new lease, that's what you're going to do. You're going to reduce your space. So that's my layman's take, or my lawyer's take on what it's going to do. On the other hand, the technology will allow us to monetize certain assets once it becomes accepted.
That's very good. Maybe perhaps Dan, you can comment on that, because I know you may have been involved with some commercial real estate fractionalization and other ways. Perhaps, when price shocks occur, there is demand to enter this space and be able to uh, benefit from that, the V shock or L shock, whatever that may end up being.
Yeah, I think at this point, so real estate is an area where I see a lot of opportunity. Again, like real estate's not my area in general, but just from what we've seen from interested clients and also just comparing to prior crisis, we are entering a period in the economy where we're going to have very low interest rates, which means it's cheap to borrow. Aside from that, we're going to have people needing liquidity. So property owners seeking to release some liquidity out of their properties. And third, you have investors seeking yield. So when you put these three together, it seemed to be, at least at a high level, the right conditions for fractionalized real estate to thrive. Because you could have either somebody buying a property just because it's cheap to borrow as a way of finding yield, given that it's harder to find yield elsewhere. And on top of that, if you're an existing property owner, you could fractionalize part of it and only sell part of your property without giving away the whole thing. This is actually like an interesting area because I've heard some people talking about even retail businesses, as restaurants, for example, fractionalizing their ownership and essentially using it as a way of raising capital. I don't think that will be very widespread, but I could see some scenarios where restaurants that are potentially going down, they would be in a dire situation where they say like, well, this may not be up to regulations, but the other option is going bankrupt, so I might as well just do an ICO type of offering among a bunch of friends or something to keep me afloat. Where I do think there's like a very good opportunity, like within the existing regulatory framework, is within trade finance and account receivables factoring. Those are two areas where there's a lot of paperwork and very manual processes that with blockchain you could really speed them up and bring a lot of value to it. Again, going to the grain chain example, where we were able to optimize what used to be a 2-3 month payment cycle between a farmer and a buyer. In trade finance is the same thing. You have somebody that is shipping something somewhere and they're not going to get paid until it gets there, and along the way there's a lot of parties that touch that product, and in the meantime the business that sold that product has to finance that working capital. So I think like in trade finance and just factoring in general, there's a lot of opportunity to really speed up those processes. And this is a situation where a lot of companies will realize that investing in that type of processes to improve working capital would make a lot of sense.
That's phenomenal. That's great. And I think in the finance in general, from where we sit, consumer finance and even public finance will definitely need to get even more advanced in terms of establishing credit and be able to get liquidity at the point of sale, and we certainly are seeing that the both in the credit card business, which is effectively revolving credit to the consumer, and the movement toward e-commerce, essentially binless meaning that your Visa MasterCard was a way for the merchants to be able to trust the card and be able to extend, but that potentially can be essentially you could have a fourth rail, which is not one of the big validators, if you will. So you're going to see that. The question is, when do you go all the way to blockchain, or even if you stay within IoT side, Internet of Things and apps and wallets and whatnot, you don't need to go all the way to crypto to be able to effectively have an intermediary in between the merchant and the consumer that needs the product and be able to evaluate the credit and extend the credit on a very short period of time, and create alternative ways for people to get through liquidity. That's one area. We're seeing that governments are looking for ways of getting money in the hands of small businesses, for example. That's validating the payroll, validating even the PPP, which is what the Treasury had announced as a small business association loans. Those SBA loans require effectively a validation of your payroll for 2019 and the forms and this and that. That potentially that channel was not really smoothly established before, but we could see that given the kind of emergencies that may rise, people may decide that to put those in place. We are seeing microfinance in India, for example. There was a lot of movement in that area, so the effectively people were trying to provide credit to small hole in the wall merchants effectively, which were doing quite a bit of business, and it was pretty local. So we're seeing that those initiatives are getting a boost, meaning that people are going back to them and saying, look, we should have really been at a much faster pace getting there. And I think those may move forward. So in terms of going back to Jason, you brought up the leases. People who have just signed their leases last year, should they be crying, or should they be contacting a lawyer and pull a what is called MAC, which is a materially adverse condition, to get out of the leases? I'm not trying to give bad lessons, but obviously part of the resolution of crises is always dealing with and doing swiftly with credit bottlenecks, right? Resolution to between the parties and the dispute side. I'm assuming the dispute is going to rise quite dramatically here.
Well, you're absolutely right that disputes are going to rise dramatically. That happened in 2000 when you had the dot-com bubble bust. It happened in 2008 when Lehman fell apart and Madoff popped up. And as a matter of fact, Lehman is still going strong. I continually get notices from the court on both Lehman and Madoff. So I think they're both over 10 years now. Litigation always pops up, but what I will tell you is, if you're trying to get a material adverse change clause or a material adverse effect clause or a force majeure clause, they're not that simple or straightforward. Oftentimes the law, and it's different in each state. So you're going to have to look at the contracts you're dealing with, and you're going to have to say, okay, what state law applies? Sometimes it doesn't address it, which means that you'll have to deal with which party's state should apply. But once you get past that and you look at it, what nearly all of these things say is that the events have to be specifically contemplated. So the force majeure provisions, for example, most of them don't contemplate a pandemic, because the last pandemic we had was about 100 years ago. And no one really thought about it on a worldwide level. No one really thought about it. So I'm skeptical that people will be able to unwind their commercial obligations. However, I also believe that in many cases, courts will be sympathetic to parties, and they're going to push both sides to settle, so that one side gets some money, the other side gets their out without having to pay this crushing debt, and everybody kind of moves on. That will occur, but it's going to take 3 to 5 years for regular litigation to kind of smooth that out. And then you always have bankruptcy. Bankruptcy can take a lot longer than that. It could also be a lot shorter depending on the assets and what's involved. So we're going to see a spike in litigation. We see it every time something that is remotely similar to this happens on a country level. This is a worldwide level. I also think that a lot of people are going to cooperate. Most of the lenders that I've heard speak about this have said they're entering into forbearance agreement. They're actually going out of their way to show empathy. But if you were a borrower and, or if you're a tenant and you were on the edge and you were already in default, it's going to be less sympathetic because this is not a problem that was caused by COVID-19. So I suspect that we'll see that playing out in many different interconnecting circles over the next 2 to 3 years, but I don't think it's going to start until about June because of the 90-day moratorium that nearly all of the states had, and the way that the country is trying to get funding to everybody.
That's very good. That's a good perspective that you provided. I get behind your comments that you're probably fairly negative on at least the short and intermediate prospects of at least commercial real estate. But the reverse, do you feel that if somehow we would, through replacement and through other business activities picking up and taking that slack, do you believe that residential market is also in trouble, or you believe that potentially can actually go on a skating?
I think that there's a lot more protections for the residential markets. I was reading in one of the reports, I believe that the US government has extended, what would you say, the ability for people that have Fannie and Freddie loans. Yes. So that's largely any commercial, any residential loan, I think it's under $700,000 is a Fannie or Freddie loan. And so probably, I think it's really
no, it's around depends on the state and the specific areas, but let's call it between 500 and 600.
Right. So if you have a mortgage that's below that, then you're going to have a significant amount of time to reduce your payments. And whether it'll be as a modification or forbearance agreement, it'll determine. But that strikes me as potentially enough time for the vast majority of residential individuals that get into trouble to have the economy pick up, have them get their job going, and deal with the arrearage over time as long as they're making regular payments. So I suspect that that's going to happen. And by the way, I wouldn't say that I'm necessarily negative on commercial real estate. I think they face significant problems, but I've seen a lot of ingenuity. So I think that what I would say is if you have a commercial loan that's been in distress, this isn't really going to change it. It may give you more time, but only if you could find refinancing. So it really is very, very circumstantial. I don't think that it's going to happen on the majority of residential loans. That's the tea leaves that I'm reading right now.
Excellent. And as you probably are aware, in addition to Fannie and Freddie, the Fed had announced a program called TALF. TALF is really a troubled asset solution where they would, in order not to continue bringing new finances to the market, that means new issuance, whether it's in the consumer space, credit cards, autos, student loans, and whatnot. They're providing essentially fairly cheap money to get a 10 times leverage without mark-to-market. In the prior iteration, it took him a long time to unleash that and get that going. In this iteration, they're essentially dusting off quite a number of these programs pretty quickly with the law firms, and they're able to put in, bring them to the market to be able to get at least make the financial markets not only impact the existing loans in a bad way, but also not totally stop new lending. Because today we had JP Morgan Bank of America, and I believe Citi and other banks reported, and by and large, most of them were down 40% year over year on the these single month revisions. Single month data. It looks like, had Michael joined us?
Yeah, no, well, this is Sydney. We're running out of time, Ron and Jason and Dan. We have one question. Actually, we have two questions. I just sent it to you guys through a chat. Could you guys answer that quickly, if you don't mind? We're running out of the time. We have only 2 or 3 minutes. So start with you, Dan. Can you answer that question, or Jason? One of you guys, and both of you. That was a question from Jason and Dan. Inside presentation. My question, Dan, you mentioned about the current challenges experienced supply chain, especially in the food chain, and have collapsed, the lack of the relationship, and you have the rest of it. Can you read the question for audience over there?
Yeah, I'll summarize it. So right now, there are reports of farmers and producers essentially dumping their products like milk and other supplies. Well, some supermarkets are going empty and they don't have products. So what is the question is, what would I suggest right now that can be done? Unfortunately, at this point, there's not enough visibility across the supply chain to a way that you could effectively say, okay, connect this guy with this other one. We don't have that type of transparency across the complex web in supply chains. The solution right now, and as unpopular as this may be, in a blockchain and decentralization focus group, would be for the government to step in, see it from the high level and say, okay, we have all this product here. We have this other city or area that needs all of this. And then you just come in and essentially connect those dots together. I've heard rumors, and I hate to pan the rumors, but essentially there's been a lot of pictures and anecdotal evidence of allegedly the National Guard coming in and telling a farmer that they may come in and take their stock at some point in the near future, stuff like that. As horrible as that sounds, I think, like, in terms of redistributing the supply chain to where it is needed, you definitely need a higher authority with a global view to be able to, well, with a countrywide view to be able to distribute that effectively. That is not the situation we want to be in the future. And in the future, I hope that supply chains are transparent enough so that you can actually have all the players interconnected in a way that you can very quickly see where things are and how you can move them to avoid this mismatch between a buyer and a seller.
Same question for you, Jason. Correct.
So I understand the supply chain issues, and I agree with much of what Dan said about that. I don't think that the government is fixed to do anything with the supply chain. If you look at what happened in Russia, their entire economy, or the USSR, was based on the government being able to fix things and do things, and they did a terrible job. You had piles and piles of moleskin that was rotting because they couldn't get it from one place to the other. So I don't think that that's going to work. And I would be really surprised if our government did that, because I think that it's unconstitutional. And, you have the issue of a taking and whether you're paying fair value for it. But I just don't think that our government is able to do that, and B, can or should do that. So I hope that that doesn't happen. But I do think that whatever transparency we can get, and if the government helps to provide that transparency so that other individuals and entities that are in the market can actually start the market up again, that's the most efficient way to do anything. And that's the only way. My understanding of the supply chain issues is that a ton of truckers didn't want to work. They were worried about getting sick. And now that you're seeing a lot of the data coming out, the data is suggesting that it's not that our understanding of the way of the effect of the virus and how it's transmitted has changed or grown. I suspect that we're going to get the supply chain back, because it really is, all of this strikes me as things that are occurring on an individual level to affect the market overall.
All right, Ron, there's a question, last question for you, then we have to move on to the next panel. And I just So actually,
Oh.
send it to chat over there. If you answer that over there, then we'll go over there. And this is from Douglas. Cindy, do you think that you can read it? Do you and you summarize it over there? Thank you.
Are you referring to the Fed and U.S. government concerning
Yeah.
the fiat currency is afraid of the potential power of
Yeah.
Bitcoin?
Yes.
Look, that I think there are a lot of conspiracy theories out there, and in general, I think I was attending a previous panel. We heard quite a bit of China going back and forth, accepting Bitcoin and not accepting Bitcoin, wherever it fits its own goals. I wish we were as centralized, if you will. So I don't think there is a general conspiracy theory of fiat versus essentially what are considered non-central bank controlled currency. I think what we are seeing and the level of conversations that we're having and the lack of adoption has really had to do with that in the U.S. there is the Congress, there is the SEC, there is the Fed, there is Treasury, then there are local governments, and then there's FDIC, and then behind the scene you have the issues of KYC and very strong interest to make sure that we are not creating a black or gray economy in general, and that I think the key issue is that it's going to take a while because you don't really have what I consider a conductor here, and generally speaking, that would require an act of essentially Congress, and that as we are in the situation we are in, it's not their first priority. Second, I think you have a very divided political system. So with that in mind, I believe that, just like everything else, democracies are slow, but ultimately we'll get where we need to get. And I think the fiat definitely is not going away. And the question is whether, essentially cryptocurrencies find the right place within the system to complement, essentially a complete payment system across and a storage and investment vehicles that go along with it. And that is just the evolution that we all have to be patient, but we know that evolution is in place.
All right, so thanks, Ron. Thanks. So in that notion, we all have to stash our dollar under our mattresses. That's what you said, yes.
No, with
I'm
the
just
Fed
kidding.
being behind the banks, I believe that the dollar will continue being the strongest medium of transfer and
Okay.
storage, and I wouldn't be shorting dollar anytime
All
soon.
right. Well, thank you very much. Thanks, Dan. Thanks, Jason. You always going to be and Rondovari. Appreciate you. We got to go to the next panels. You all have a great day.
Thank you,
We're going to
Sidney.
continue.
Thank you so
the
much.
audience. We're going to continue with a couple of great panels. We have people from Japan, from South Africa. So this is our international panel. And if